Forex trading is not quick money.
All in. The bet is 2,000. Call or fold?
I call.
Stop scrolling. Stop dreaming. If you came here looking for the secret button that turns $100 into $1 million overnight, you are in the wrong place. And frankly, you are about to lose everything. The biggest lie sold in the financial world is that Forex trading is a path to quick, easy money. It is not. It is a brutal, unforgiving business. And today, the Trading Jagaban is going to give you the hard truth. The truth that separates the dreamers from the earners. The truth that will determine if you survive long enough to see a profit. Welcome back to the Trading Jagaban. And for years, I've watched the cycle repeat. A hopeful beginner, seduced by promises of instant wealth, enters the market, ignores the fundamentals, and is wiped out within months. This isn't a game of luck. It's a game of skill, discipline, and most importantly, survival. The consequences of ignoring this truth are not just financial, they are psychological, and they are career-ending. The consequences of ignorance. What happens when you treat the market like a casino? You blow up your account. It's not a possibility, it's an inevitability. The moment you prioritize the size of your potential win over the size of your potential loss, you have signed your financial death warrant. The first consequence is the account blowout. This is the terminal event, the moment your broker sends that final cold email. But the damage starts long before that. It begins with psychological erosion. You take an oversized loss, and your mind immediately shifts into revenge trading mode. You double down, you abandon your strategy, and you trade purely on emotion, fear, greed, and desperation. This cycle doesn't just empty your trading account, it poisons your decision-making in every aspect of your life. The market doesn't care about your rent, your bills, or your dreams. It is a machine designed to transfer wealth from the impatient to the patient. If you ignore the reality of risk, you will be the source of that transfer. Beginner versus professional behavior.
No, it can't be. It hit the stop loss. What happened?
Are you okay?
The difference between a beginner and a professional is not the size of their wins. It's the size of their losses and their approach to the market. Let's break down the fundamental contrast. Aspect: the beginner, the gambler; the professional, the business owner. Primary focus: profit. How much can I make today? Risk. How much can I lose today? Strategy jumps between holy grail systems, uses too many indicators. Simple, tested, and consistently executed. Position sizing arbitrary, trades based on emotion or desire for a big win. Calculated, uses a fixed percentage of capital per trade. View of trading, a lottery ticket, a way to escape the 9-to-5 quickly. A long-term business, a statistical edge to be exploited over thousands of trades. Response to loss. Emotional, revenge trading, doubling down. Detached, reviews the trade, accepts it as a cost of doing business. The beginner is looking for a shortcut. The professional understands that consistency is the only currency that matters. They are not trying to hit a home run. They are trying to hit singles and doubles, day in and day out, while ensuring they never strike out completely.
That's enough. I want everyone's attention right now. We have a serious problem.
Practical examples. The pillars of survival. Let's move from philosophy to the cold, hard math. This is where the rubber meets the road. The professional trader's entire existence is built on 3 pillars of risk management. Pillar 1. Risk per trade, the 1% rule. You must define your risk before you define your reward. The non-negotiable standard for any serious trader is the 1% rule. This means you never, under any circumstances, risk more than 1% of your total trading capital on a single trade. If you have a $10,000 account, your maximum loss on any trade is $100. This is not a suggestion, it is a law. Why? Because a 1% loss is recoverable. A 10% loss is a psychological blow. A 50% loss requires you to double your remaining capital just to get back to break even. Pillar 2. Position sizing. This is the practical application of the 1% rule. Position sizing is the calculation that tells you exactly how many lots to trade. It is not a guess, it is a formula. Risk amount, for example $100, divided by stop-loss distance, in pips converted to currency value. If your stop-loss is 50 pips and you are risking $100, you calculate the lot size that makes a 50-pip move equal to $100. This calculation ensures that no matter how wide or tight your stop-loss is, your capital exposure remains exactly 1%. Beginners trade a standard lot because it feels right. Professionals trade a micro lot or a mini lot because the math demands it. Pillar 3. Drawdowns. A drawdown is the natural, inevitable decline in your capital from a peak. Every trader experiences them. The difference is how they manage them. Imagine you suffer a 20% drawdown. To recover and get back to your peak, you don't need a 20% gain. You need a 25% gain. If you suffer a 50% drawdown, you need a 100% gain just to break even. This is the brutal arithmetic of compounding losses. The smaller your risk per trade, the shallower your drawdowns will be, and the easier it is to maintain consistency and recover. If this reality check is hitting home, and you are ready to trade like a professional, hit that like button and subscribe to the Trading Jagaban. We release new, grounded content every week to help you navigate this market without the hype. The core philosophy: survival over profit. The professional trader's mantra is simple. Capital protection is the only priority. Profit is the result of excellent risk management, not the goal. Think of your trading capital as your army. Your job is not to win every battle. Your job is to ensure your army survives to fight the next day. If you lose 50% of your capital, you have effectively lost 50% of your ability to trade. You have crippled your edge. The market will always be there tomorrow. The opportunities will always present themselves. Your only job is to ensure you are still there to take them. This focus on survival forces you to be patient, to wait for the highest probability setups, and to walk away when the market is unclear. It is the ultimate expression of discipline. We started this video by dismantling the myth of quick money. We've covered the consequences of ignoring risk, the stark difference between the amateur and the pro, and the practical math of position sizing and drawdowns. Now, I will leave you with the single non-negotiable rule that every successful trader lives by. If you forget everything else, remember this, the one rule. Never risk your survival on a single trade. Your goal is not to get rich this week. Your goal is to be a better trader next week than you are today. Your goal is to be in the market 5 years from now. And the only way to guarantee that is to protect your capital at all costs. If you are serious about this business, if you are ready to commit to the hard truth, let me know in the comments below. Tell me, what is your risk percentage per trade? I want to see how many professionals are watching. Like this video, subscribe to the Trading Jagaban for more grounded truth, and click the notification bell so you don't miss our next lesson on mastering the market. Until next time, trade safe, trade smart, and protect your capital. This is the Trading Jagaban, signing off.
No, it can't be! It hit the stop loss! What happened?
Are you okay?
All in. The bet is 2,000. Call or fold.
I call. That's enough. I want everyone's attention right now. We have a serious problem.
Forex trading is not quick money.